Hey guys, Whitney here. Thanks for joining me, especially the day before Thanksgiving. I really appreciate it. All right, I got 10 o'clock my time. We're just going to give it another minute for people to join. But while we're waiting in that time, if you please would go to your chat box, and I just want to make sure that you can hear me and see my screen. So if somebody will just confirm that for me, that'd be fantastic. Yay! Love it. Nothing worse than getting partway through a webinar and somebody goes, I can't hear you. All right, perfect. All right, I got 10:01. Let's get started. We got a ton to cover today. So this is another episode in our passive investing series. This is going to be a really special episode because we're not actually going to focus so much on the syndications, but we're going to hold a little bit of a discussion around some of the tax implications. So we're going to really be talking about the top tax changes that will impact real estate investors under the Biden tax plan. Now, I'm going to keep this presentation apolitical, meaning we're not going to talk politics, but and I'm not a tax advisor either. So, I will do my best to answer questions, but we're going to keep this pretty much like educational. So let's talk about what we're going to cover today. So we're going to tackle, learn the top proposed tax changes in the Biden tax plan. We're also going to learn why it's important for you to understand about these proposed tax changes. And we're going to actually discuss a little bit the impact of these changes how they might have on your portfolio, your real estate, your other investments, and what you might be able to do about that. Okay, so I am going to leave you with an action plan at the end, so stick with me. But again, these webinars, if you haven't attended one of these webinars before, our Goodegg live master classes, really what we try to do here is to help you understand how to invest in syndication. So maybe you've had cold feet before and never invested, or maybe you tried investing in syndication and you made a mistake, or maybe you want to invest in syndications and you were just totally overwhelmed by all the information out there. This investor series that I do is for you to help you overcome these obstacles to investing in syndications. But hey, let's talk about, if you don't know me, my name is Whitney Hutton. I am the Director of Investor Relations and Operations here at Goodegg. This is my crazy crew on our last out of the country adventure. This was in Mexico in January. We standing on top of the Coba Pyramid and outside of Tulum in the Yucatan Peninsula. Anyways, but this is kind of the epitome of why I invest in real estate. I started investing in real estate in 2002, doing live-in flipping and house hacking. My husband joined me in that strategy in 2006. We did very well in that strategy. However, what we realized that we didn't have was passive income. So it took us a while, maybe call us slow learners, but it took us a while, and we eventually transitioned into buy and hold investing and scaled up, over 30 rehabs and 10 flips doing that, executing those two strategies. And then I went to my husband and said, hey, I would love to step back and spend more time with my daughter. And he said, that's amazing. I want some of that too. And that there led us into multifamily. And that's how we, made the switch into multifamily. We needed scale, we needed passive cash flow, and we needed stability. And, we sourced our own projects, but also I joined Goodegg here about a year and a half ago. And with Goodegg, we've done over 25 deals in the multifamily space. Majority of those deals are B-class multifamily value add. We have a couple stabilized properties in the portfolio as well. And we've done over 65, we have 6,500 multifamily units and a $750 million portfolio value. But the cool thing that I get to do on a daily basis is work with you guys, our investors. So we have a fairly large verified investor base and a high return rate for our investors. So they really love the product and our service and what we're able to do for them. And even in the midst of COVID, these are some of the things we've been able to achieve this year. We've gotten our book out, our Investing for Good podcast is coming up on its 1-year anniversary. We were able to see a majority of our properties and do site visits this year, as well as meet with our operators live and in person, and many of you are investors at various conferences. So if this is your first time, welcome. Thank you so much for joining. But I just want to kind of put up a little kind of quick recap on things that are in other parts or other episodes I've done in the series. So you're going to get a replay of today's webinar, and you can open that email. And if you scroll down in that email, there will be links to other webinars that I've done covering these various topics. So, when I talk to investors on the phone, and I'll show you how to join our Goodegg Investor Club here in a second. But when I talk to investors on the phone, I oftentimes am answering, very how-to questions like, how do you underwrite an operator? How do you underwrite a market? How do you underwrite a deal? And so I've put together several webinars to help you kind of navigate these different areas. So check out that replay email. All right. Well, let's dive in because we've got a ton of information to cover today. Again, these webinars are for you. They're not for me. So I want to make sure we're providing value. So let's get started. All right. I got to put this up there. Again, what we're covering today is tax changes under the Biden tax plan. However, what I'm sharing with you today is purely educational. Please do not take this as any legal, financial, or tax advice. Make sure that you're working with your proper professionals. I will try to answer questions where I can, but you might hear out of my mouth a lot of "it depends." So, and it really does. How these changes will impact people really will depend on your individual situation. So let's dive in. What I ask, since we have a lot of material to go through, is you find your chat box, and if you have questions, jump over to the chat box and ask your question, and I will do my best to answer the question in order, of how we're covering the topic. Otherwise, I'll hang out for a minute at the end. We'll clean up any other questions that you might have. All right. So, and we're not going to cover all the tax changes in the Biden plan, but we're going to cover some of the top changes of what to expect. So one of the top changes is Biden's looking to restore the pre-Tax Cuts and Jobs Act tax rates. Okay, so revert everything back and increase Social Security taxes for individuals who are making an income over $400,000. So basically, this would be a proposed immediate change. The tax rate, the top marginal tax rate would jump back from 37% back up to 39.3%, or excuse me, 39.6%. Now, what are some things that you can do about this? Well, if your income is above $400,000 threshold, this can mean that you might be subject to increased taxes. So you might want to actually consider putting in some effort to offset your potential increase in taxes through a strategy, say like pursuing a real estate professional status, okay? That's not a job designation, or you don't have to get a certification. That is a box that you can check with the IRS. And this would actually, by achieving a real estate professional status, it would help you apply your real estate losses to other income. Now, I would strongly suggest you talking to your CPA about this if this is a tax strategy that could apply to you, okay? And especially if you've got any sort of active parts of your portfolio, this is something that you should talk to them about. All right, so that's tax change number one, okay? The reversion in the tax rate, okay? Number two, under this tax plan, now guys, remember tax plans are exactly that, is a plan. It doesn't mean that it's actually all going to happen. Right? You're going to have Congress involved. And Congress has a large Republican constituency right now. Again, there's going to have to be some bipartisan leadership in order to get these things through. Now, the other big thing that I think people are looking at are increased capital gains taxes for high income earners. So let's talk about this for a second. When you sell an asset for more than you paid for it, this triggers what we call a capital gain, okay? And it can apply to stocks, bonds, precious metal, jewelry, real estate. And the tax you pay on the capital gain depends on how long you actually held the asset, okay? So capital gains can be classified as long-term or short-term, all right? Generally, short-term is if you held the asset for a year or less. Long-term is a year or more. Now, long-term gains are derived from assets that are held, again, for more than one year and are disposed of or sold. And so what this change actually proposes is that it would replace the long-term capital gains rate with an ordinary income rate for taxpayers who are earning 1 million or more. Okay, so very, very clear here. This increased capital gains rate does not apply unless you're earning more than 1 million. Okay, now what are some things that you can do here? Now, if this potential change impacts you, you might want to start by evaluating your current holdings and goals. So if you're planning on holding your assets long term and have no intentions of selling in the near future, this maybe won't impact you at all, right? The whole tax structure might change again in the next 4 to 8 years. So you can consider to continue holding on long term. However, if you're planning on selling, say in the next year or two, and paying these long-term capital gains taxes, it might be worth consider selling now before these changes go into place. All right. All right. Next, we've got the eliminated, the proposal is to eliminate the step-up basis at death for capital gains. All right. So let's come up with an example. Let's say, when my grandfather passed away, he had a house that he owned. And there was I didn't inherit it, but my some other family members inherited it. And I'm not going to go over the exact numbers, but let's say that he bought the house at $50,000. Okay, many moons ago. But when my uncle, who inherited the house, went to sell it, the house was worth $300,000. Okay, so there was a gain of $250,000. Okay, under the current tax plan, my uncle would get a step-up in basis and would not pay, if he sold the house for $300,000, he would not pay taxes on that $250,000 spread. So he wouldn't owe any federal income tax on that sale. Now, however, with the proposed changes here, Biden would actually eliminate the step-up basis. Okay, so you get to take the initial $50,000 basis in the home, which is what my grandfather originally spent for it. But if you were to sell that house, he would have to pay taxes or a capital gains tax on the gain, which is that $250,000. So what can you do about this? If this particular tax change, you think it's going to impact your family in the coming years, make sure to talk to a tax professional and see if there might be a better strategy or a better time to gift these assets and avoid the tax implication. If this tax step-up basis were to be actually eliminated. All right, I know you guys love talking about opportunity zones, but opportunity zones and 1031 exchanges are actually proposed to be phased out. So, with opportunity zones, if you don't know what an opportunity zone is, essentially you can actually roll over your gains from another asset sale into a qualified opportunity zone fund. And this will help you defer your capital gains tax burdens. That's the way they're set up right now, okay? Potentially indefinitely, okay? If your capital remains invested in that opportunity fund for over 10 years, okay? So that's what an opportunity zone is. A 1031 exchange is where you can sell one real estate asset in exchange for a like-kind investment to avoid paying the capital gains tax on the sale of that asset, okay? So there are two different mechanisms on deferring capital gains taxes, okay? Now, under the Biden plan, he has proposed to alter these programs by phasing them out or eliminating them altogether. Question, can I give an example of an opportunity fund? I don't have one specifically, but in an opportunity, so in my area, an opportunity zone might be, we have some rail yards that are being converted into, we're incentivized, the city has designated their old rail yards for multifamily and mixed use development in order to encourage investors to go in there and develop that area. the city will have designated them an opportunity zone. An investor will go in there and set up on a qualifying opportunity zone fund. Investors would roll their monies into that fund to fund that investment. So it is another, it's kind of like a syndication. It's just another type of syndication. It's just this very specific where the city has to actually designate where the opportunity zones are that need to be developed in that area. So it can be just parts of the area that need to be revitalized. And, I've seen old textiles be converted into multifamily buildings. There's all sorts of things that can be designated opportunity zone funds. Opportunity zones. The city gets to designate the opportunity zone, not the federal government, okay, and not the investor. But let's go back to like what to think about, like how this, is actually might play out. I don't have a crystal ball. My crystal ball is broken when it comes to, tax planning in politics. However, it's, I think it might be wildly unlikely that Biden will actually be successful at fully eliminating these programs, okay? But, we have to entertain the possibility that this might happen. So if you have properties or other investments you've been looking to sell, we need to come up, I would encourage you to talk to your CPA about other strategies you can employ to defer the capital gains, okay? Again, we're going back to that capital gains. And we need to, strategize on how to reduce that tax burden for you. So this might be a good time to sit down and understand what your long-term plans are for your assets that you are holding, okay, and plan for that capital gain. All right, phasing out of QBI, qualified business income deduction for high income earners. Now, back when the Tax Cuts and Jobs Act, okay, there was a clause in there that made it possible for people who are self-employed or small business owners to deduct up to 20% of their qualified business income, QBI, from qualified trades or businesses, including real estate ventures. So essentially, if I made $100, if I could, save right off the top 20%, okay? And this depends on how my entity was structured and everything like that. Now, that's awesome, okay? There was kind of a pass-through tax deduction already right there built in. Now, the Biden tax proposal would actually phase this out for high income earners making over $400,000, okay? It's not being phased out for everybody, but really for high income earners making over $400,000, okay? That doesn't lessen the impact, but just want to be very clear about who is this being phased out for. So what do we need to think about? If this is actually passed, this actually can impact a significant number of real estate projects and business projects, right? So it might be worth discussing with your CPA and the impact of this change on your overall real estate tax picture. So, and especially if you're owning active real estate, talk with your CPA on, does in your entities are making over $400,000, talk with your CPA to make sure that you are, again, taking into account these higher taxes or the elimination, that 20% pass through. All right. So the other thing that's being proposed is implementing a first-time home buyer tax credit, for $15,000. Now, there was one, and I don't know if you guys remember, or if you guys were investing in real estate at that point in time, but in the Great Recession in 2008, Congress actually passed the Housing and Economic Recovery Act, okay? And in that, there was, I believe it was an $8,000 tax credit to encourage homeownership and stimulate the US housing market. And the reason is that it's not that people actually don't want to own a home, but they can't because of the affordability. So that's why these tax credits go into place. So in this particular case, Biden has proposed a similar plan to that of 2008. But again, instead of $8,000, it's now $15,000 to allow people to access affordability and accessibility for first-time homeowners. Now, how does this impact us? Well, if you've never owned a home before, this might be a good time to buy, right? $15,000 tax credit, that's not a tax deduction, okay? Tax credit offsets dollar for dollar of income. Okay, it is money in your pocket. So that might be something to take advantage of. All right. You know, with this, if this tax credit's passed and with the low interest rates, again, it might be a really good time to buy. Now, what if you are not a first-time home buyer? Okay, this still could impact you because now the market might become more competitive and allow renters to purchase homes. Okay, now, will that significantly reduce the renter pool? Maybe. Maybe it might impact the renter pool, but we have like a very high renter pool across the United States right now. I think where it might impact people more is that assets might continue to go up. It'll drive up the demand in the residential real estate. So if you are thinking of purchasing rental properties, as the increased demand, this could actually lead to housing prices increase. So that might be a good thing for you if you have residential real estate that you want to reposition. Okay. All right. Let's talk. I got somebody else joining. Hold on right there. All right. So another change that's being proposed is reducing the estate tax exemption from 11.18 million down to 5 million. Okay. So this one's a pretty, direct, not a whole lot to really discuss here, but essentially this is reverting back the Tax Cuts and Jobs Act, which doubled the estate tax exemption from up to 11.18 million for individuals. Okay, so what that means is that when somebody passed away under this, currently their assets up to $11.18 million did not have an estate tax due on them. Okay, so Biden is, reverting that back to $5 million. Okay, with this particular change. So just eliminating that provision in the Tax Cuts and Jobs Act. So how would this impact you? Well, this potential real estate tax reduction in combination with the elimination of the step-up basis could mean that your estate might get squeezed should you, have assets over $5 million. Okay, so if you do have assets over $5 million, you should consider talking to a CPA professional about gifting some of your assets now before the end of the year. Okay, in order to avoid this particular potential change. Again, these are all potential changes. Okay. All right. Elimination of bonus depreciation. This is the last one we're going to talk about right now, but this is one of the most impactful things to come out of the Tax Cuts and Jobs Act for real estate investors. Okay, so essentially the bonus depreciation allowed a real estate investor to immediately deduct a large percentage of the purchase price of the eligible asset through bonus depreciation and the rehab without writing them off little by little over time of that asset. So it's a form of accelerated depreciation. I want you guys to understand that depreciation and accelerated depreciation aren't, as far as we know, as far as we've been advised, aren't being touched in this particular case. It's just the bonus depreciation specific around the improvements on the property. So say you were spending money on improving the property, new appliances, furniture, landscaping. Currently we could use the bonus depreciation to deduct the entire cost in the year that we spent the money. Okay, that would actually be eliminated altogether. So this would impact the numbers on K1 statements for investors, but again, we're still going to have the accelerated depreciation. We can still go do cost segregation on our particular properties. Okay, so that can still happen. Again, how it would impact you, I think we discussed that a little bit. I would talk to, again, your CPA to understand, exactly how, if you have other assets that utilize bonus depreciation, how that will impact you going forward. So again, looping in your professional is going to be the next best step. All right. So I'm going to wrap it up with a little plan for you to take a peek at. So, you know, as you can see, it's if these changes are going to impact you, right? Especially if you earn over $400,000 and have an estate over 5 million, this is going to be very impactful to you, these tax changes. So make sure you're assembling your team of trusted professionals to help you navigate any potential changes that might occur next year. It's always good every year to sit down to define or refine your investing in life goals, you know. Make sure that you're staying on track. I love the analogy of how does a plane get from Los Angeles to New York whenever it's constantly going off course by over 1%? Well, it course corrects, okay? This is a great time of year for us to sit down and refine our investing in life goals and course correct for any changes that might be coming our way. Again, if you have, if you hit the over $400,000 mark, and you know, I don't want to limit this to people who make over $400,000 or have 5 million in assets, but especially if you fall in those categories, see what you can do to qualify that for that real estate professional status, and a CPA can help you figure that out. If you're thinking of repositioning properties in the next year or two, or any sort of asset that might trigger a capital gain, consider actually doing it sooner, like now, rather than later before these changes take effect. That way you're paying the lower tax rate. You know, something that was advised to me is, you know, we're looking to make a conversion, you know, into a Roth conversion. I should consider doing that now, you know, in order to pay the lower tax rate. Also, you know, again, depending on the size of your estate, work with a professional to see about gifting assets to heirs now. Again, you know, to utilize lower tax brackets, but also to reduce your income tax, or excuse me, capital gains tax burden. Yeah, James, yeah. And I remember I did put it in here, this last point. Consider converting some or all of traditional individual retirement accounts to a Roth, okay? Again, so you can pay that lower tax rate now. Now, again, none of this is financial advice, none of this is investment advice, but these are just things that, you know, are, as we are looking at the various parts of the Biden tax plan, you know, we want to put in front of you, you know, so you can have an open conversation with your professional team and set yourself up for success, right? You know, taxes are one of our #1 expenses, and if we can reduce that, all the better, you know, for helping you build your wealth. All right, so I know I've done a lot of talking here, so I want to give you guys some time to ask your questions. So jump over to that chat box, type in any questions that you might have. I'll answer the questions first surrounding the, you know, any proposed tax changes, and then we can open it up to like just complete AMA from there. But while you guys are getting your questions dialed in and typing them in the chat box, I just wanted to let you know how you can join the Goodegg Investments, Goodegg Investor Club. So if you want to be on our list to see our deals, you got to join the Goodegg. Two things you got to do. You got to join the Goodegg Investor Club. So this is how you apply. You can go to goodegginvestments.com/invest. And you have to watch for the email to set up a call with me, because you and I got to hop on the phone so I can get to know you better in your investing goals. And then we can, you know, give you access to our deals list. So if you currently aren't seeing the deal flow that you want from us, it probably means that you're not in our Goodegg Investor Club. So do that now. Just go ahead and you know, hit that website, and it's really easy. It takes you about 30 seconds to apply. But the club's for anybody, whether you're starting out, doing this on the side, haven't done a deal yet, or if you're an investing pro and you've got tons of syndication deals in your back pocket and you're doing this full time. And as always, I do these webinars for you. So I would love to understand, you can drop this in the chat box as well, what other topics you would like to see covered. So I keep a running list of topics. So make sure to drop that in the chat box as well. All right. Oh, we got a comment. We have a certified financial planner on the call who says, I'm a big fan of the Roth conversions, as long as it's the right financial move for you individually. Absolutely. Yep, you have to work with your professionals. Again, You know, it's what we're doing is, kind of think of it like the Matrix. We're just kind of like dangling the little red pill in front of you to kind of look at things a different way. But for you to have full empowerment, you got to go back to your team and work with your team. A certified financial planner, certified CPA, to really help you dig into what your full plan is and help you create the one that's best for you, for sure. What other questions do you guys have? Go to the chat box now. All right. As you guys are typing in your questions, I'd love to hang out here and answer any questions related to the information that we've gone over. Also, if you just have any other questions in general, go to the chat box now. I would be happy to answer those. And if you need to drop off, thank you so much for joining today's presentation. This has been great. And anyways, I look forward, happy Thanksgiving. I look forward to working with you guys really soon.